Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. I know a lot of people are trying to piece a whole bunch of things together. And I'm trying to do that to the best of my ability for everyone on the channel. And if you haven't subscribed, please subscribe to the channel. What I'm going to do here is I'm going to show you what interest rates do to stocks, specifically the Dow Jones. I'm going to show you what a leading indicator is. It's the copper to gold ratio. Usually when the copper to gold ratio increases, meaning that copper is outperforming gold, interest rates follow. There's a strong correlation between interest rates and the copper to gold ratio. And when we think about ratios, it just means that copper is outperforming gold. And under those conditions, interest rates like to go up. So think of a strong economy, stronger inflation. Think of that as that type of correlation. Then I'm going to show you the market balance of copper and why I think copper is going to go pretty much crazy to the upside. And then I'm going to go into the dollar index and housing starts. And I'm going to describe why last QE, all the money printing that happened in 2009, why nothing happened in terms of inflation. So we're going to dive into it here. So I've got the copper to gold ratio. It's up here. You're going to lose me. I'm going to zoom in as far as I can. So this is the copper to gold ratio. We were in from the late 30s, early to mid 30s, all the way to 1971. We had the copper to gold ratio outperform. So copper outperformed gold during that time frame. We were on a gold standard. When we went and freely traded from 71 to 80, that's when gold took off because they were cheating the entire money supply. They were cheating it. They were putting a whole bunch of money into the system, and gold had not accounted for it. During this time frame, we had interest rates go berserk from 40 to 1980. So the end of this boom here was kind of a fictitious copper to gold ratio because gold started to freely trade. So I don't know if I would count the 70 to 80 time frame because it was an era where gold had to account for the money supply, and that ratio contracted. When looking at this copper to gold ratio and the 10-year treasury bond, you can see from 60 to 80, and this was lower back here, that we had this massive move higher in the 10-year treasury bond. That correlates with the copper to gold ratio going up during this entire period. But keep in mind, gold took off like a bat out of you know what, because it was freely traded and they were printing more money that gold had not accounted for. We went into this bear market for copper to gold ratio where it went sideways and was extremely cheap. We were in a bear market for the 10-year treasury bond as interest rates deflated and the demographics did not support higher inflation rates. We had a little blip from a little bit after 2000 to 2007. We had a little blip from a little bit after 2000 to 2007 of interest rates, and that's this little guy here. That's the rate move, and this is the copper to gold ratio. Look what's happening right now. We have a downtrend line that is being broken to the upside. Right here, right now, we are at the bottom, most likely, of interest rates, and we're probably going to see interest rates move on higher. That's my guess, because we're going to see the copper to gold ratio, where copper most likely will outperform gold. Here is another chart. This is the copper to gold ratio and the US 10-year yield. Copper to gold ratio increases, the yield follows. It goes down, the yield follows it down, lower. What I'm just saying is that they're correlated. It doesn't mean that the amplitude, how far these things move up and down, are the same, but the direction is the same. When copper to gold ratio moves up, the 10-year yield goes up. If the copper to gold ratio is breaking a very huge pattern to the upside, a long-term pattern here of what is that, 50 years? Almost 50 years, and this starts to go higher, you're probably going to see interest rates go higher, is my guess. Here's the Dow Jones, and here's the 10-year Treasury bond. We had an increasing interest rate environment from, here's the 60 to 80 period where rates really started to move higher. During that 60 to 80 period of the Dow Jones, you can see that the stocks didn't want to go anywhere. They were compressing their price to earnings ratio and had a massive underperformance in relationship to commodities during that time frame. This is where gold from 70 to 80 went from $38 to $850. The purchasing power gains in gold against the Dow Jones was insane because the Dow Jones went nowhere. Here is the market balance of copper to show you how ridiculous this is probably going to get. Here's the problem. Copper's not being discovered fast enough to be mined to meet upcoming demand. The primary demand's in the black line. The base case production and probable projects are right here. Looking out to about 2030, we have about a 10 million ton deficit or greater ahead of us. This is going to rip copper prices higher. Copper going up will probably put pressure on the copper to gold ratio depending on the market balance of gold itself. We could see a vast move higher in both gold and copper because of the market balances and the supply and demand of these metals. If the 10-year bond goes up, the yield, you're going to see more demand from the financial aspect pile into copper and gold because it has nowhere else to go. Looking at rates and the dollar index, a lot of people say when rates go up that the dollar gets stronger. That's what a lot of people have written in the comment section. If that's the case from 1960 to 1980, we should see a massively strong dollar, right? Because we had really high interest rates. They continued to increase from 4% to 15% on the 10-year Treasury bond. So from 60 to 80, we should see a huge strengthening dollar for you guys who think that rates impact the dollar that way. Here's the US dollar index from 67 to 2015. Well, from 70 to 1980, the dollar declined from 120 something to 80 something. Wait, that goes exactly against what everyone is thinking in the comments section. Higher interest rates were trying to slow a declining dollar over time. From 80 to 84, 85, we had an increasing dollar. At the same time, we had a huge decline in real estate housing starts. That means that the gateway for inflation was closed. Money couldn't get into the system. So we had a recession deflation. The dollar increased and interest rates went down massively. So what do you think the stocks did? If the gateway was shut, the dollar index went up and interest rates declined. My prediction is that they would go higher. 1980, look at the stock market from 80 to 87. A huge move up. 80 to 87 had rates falling all the way here. Look what happened to rates in 87. It shot higher. 87, we had the gateway open for inflation. 85, 84, we went into this and inflation started coming into the system. Remember, guys, this isn't like it happens at a second pace. Things have to move and things have to open, and then inflation has to come. And then we have these huge lagging indicators like the CPI, where it takes months and months and months to get into the system and for these lagging indicators to actually read it. But the gateway was open in 83, where we started to get more inflation. the interest rate started to react a little bit after. Copper started to go up a little bit after that as well. Copper to gold ratio. Interest rate spike, copper to gold ratio up, and we had the 87 crash. Looking at the dollar again, we had a dollar top at 2001, and it declined all the way to 2008. 2001, we had a huge expansionary phase. The floodgates were open for inflation to happen through residential real estate. It crashed and went down below 2008. We went into a recession in real estate, which then put everything into a recession and a huge crash. Notice, if you were to look at the bottoms here, we had bottoms in 1980s, early to mid 80s. Early to mid 80s, the dollar went up because of a recession. 90 to 95, we had this huge decline in housing starts. 90 to 95, the dollar index was flat and then went higher. Remember, it's a lagged indication. We started to go into an expansion phase in 2000, and there's your decline in the dollar index. This stuff's delayed a little bit. It's not exact. So we've got this huge 10-year Treasury bond decline over time, which forced money, it flowed money from 1980 into stocks the entire time. From 2000, from 99 to 2008, you can see the stock market went sideways. Why is that? I were to bet that we had increasing interest rate environment and a housing boom, a housing expansionary phase from 2000 to 2008. That's the reason why we had a declining dollar, and we had a copper to gold ratio showing us that interest rates were going to go up. Interest rates went up from a little after 2000 to 2007. There's your increase in this downtrend environment. The difference here is that we could be breaking this 40-year trend into a new move like this. From the 40s, 30s, and 40s upward. How big will it be? I don't know. But what I'm trying to do is show you guys that interest rates go up when the dollar index goes down. And that goes down when the housing starts go up and we go into an expansionary phase of real estate, which are these expansion phases in here. We've never been this underbuilt before. And I think we're going to go into a very large expansionary phase of real estate, which means that the dollar index is going to come under pressure and want to go lower because the floodgate for inflation is open through the expansionary phase of real estate. We also have the copper to gold ratio showing us that it's breaking to the upside, which is more confluence to a higher interest rate if they're correlated. If they're correlated, we're breaking this huge downtrend right now. Look at that. Look at that little guy. If that goes higher, which has a long way to go higher, you're probably going to see the 10-year Treasury bond yield go higher. So that's what I've got for today. These are the charts that I wanted to present. Hopefully you guys are getting more information out of this. Hopefully it's starting to make some sense. It's once you figure this out, investing becomes super easy because you'll start to see the correlations. It's like, hey, interest rates are going up. Oh, that's going to funnel this way. Interest rates are in a declining interest rate environment. They're funneling back this way. The real estate market, what I'm basically proposing is that demographics affects the real estate market. The real estate market affects inflation, which is the opening and closing of the floodgate of money into the system. That gate being open influences interest rates to go up. Interest rates going up directs money to certain investments. That's the the way that you need to think about it, in my opinion. Now, they created a bunch of money in 2009. In 2009, I'll zoom in here. What was the problem with 2009? The floodgate was closed. Money went into the banks and got stuck there. There was no gateway into the system for inflation. It was shut. It's like, nope, sorry, you're going to stay in the banks. So the banks got recapitalized and the money couldn't be lent into existence. It was stuck. The crash happened. We went into a recovery phase of real estate right here. Interest rates dropped. PE ratios expanded. Stocks were the place to be. When the dollar gets stronger, dollar-denominated assets become favorable for investment because the dollar's going up and those investments in the dollar are going up. It's a twofold increase. Dollar stronger, so we get the dollar and currency advantage, and then those go up during a declining interest rate environment. Interest rates go down under economic problems. Interest rates go up under expansionary phases of real estate. The floodgate opens. The money gets into the system. We get inflation. Money gets directed towards precious metals and commodities because interest rates start to go up. It puts pressure on stocks and bonds. I'll do another clip on bonds so you guys can understand what bonds, how they kind of work. It's really just net present value calculations, and I'll show you what that looks like. If you guys like this content, give me a thumbs up. Subscribe to the channel if you haven't already. And thank you for listening. This is Finding Value.